Welcome to InvestaMania, brother.
Boom! What's up, InvestaManiacs? Jordan Knight here with InvestaMania, the show where we help you get rich. And we have a little fun along the way. Boy, oh boy, was I wrong. Here I was recommending recovery stocks for a trade, 3 of which were retail, and retail is, well, where I personally put most of my recovery allocated money, and these stocks got absolutely smashed. Now, I want to be clear here. I am not frustrated because the stocks went down over a couple trading days. I am frustrated because I should have had better timing. I should have thought more about what was going to happen over Black Friday. Some of the stocks I recommended, like Disney and Boeing, you can be in those indefinitely, and I still think those are good trades. I thought they were then, I still think they are now. But when it comes to the retail stocks that I recommended, you gotta take Black Friday into consideration. My reasoning for why I got into the retail stocks was simple enough. Earnings season is mostly over, and we now have a lot of really positive vaccine news coming out, and I believe will continue to come out over the next couple months. In the absence of earnings over the next couple months, I believe that the positive vaccine news will outweigh the negative news about increasing corona case numbers. Here is where I messed up. I thought, hey, Black Friday is just 2 trading days away. Black Friday should provide a lot of attention towards what has been a surprisingly strong consumer. And historically, this has been a strong period for retail stocks. That's why I thought, hey, I'm going to allocate the majority of this recovery trade money to retail. Then I saw this. Macy's flagship store in New York City, Black Friday 2019 versus 2020. It was at that moment that Jordan Knight knew he effed up. Would you look at this? Just look at it. The second I saw this picture, which was in an article from the Business Insider, I knew I had lost thousands of dollars and I needed to get out of this trade on the next trading day. If I want to get back in later, I can, but I generally try to follow a rule, which is if a trade, not an investment, but a trade goes against me for a reason I did not anticipate, I try to get out, at least temporarily. I never bothered to form an opinion on whether or not brick and mortar retail would have a strong Black Friday. I didn't really care because I was going to be out of the trading stocks before they reported anyway. Well, with a bunch of articles like this going around, I ended up being out of the trade a lot sooner than I anticipated. Fortunately, I only had about 30% of my portfolio in these recovery play stocks, with about 70% of my portfolio in stocks which did not require a recovery to do well. My overall portfolio still made a couple grand over the last couple trading days. I just would have made a lot more had I not been in those recovery names. But that's in the past. Where am I going in the future? I still want to bet on the recovery. I still think it's a good trade. I think I just messed up on exactly which stocks I got into or my entry timing, perhaps. So I actually want to increase my allocation above the initial 30%. That was just the starting place for where I wanted to go. But I want to obviously change which recovery stocks I'm going to be in, at least for the time being. So I'm in the process of getting out of the retail stocks and the sit-down restaurants, and I'm going to be getting into a couple others. I'm still working on the portfolio. I should have an update within a few days. I'll let you know. Let's take some viewer questions. Call of Duty for Life asks, I plan on holding it for a while. I think they have a lot of room to grow. Do you think it's a good long-term hold? He was asking in reference to the mattress company Purple that I did a segment on it was about a week ago. Purple is up sixfold since its March lows and has more than tripled year to date. Purple has been a wonderful stock this year. I mean, just absolutely blowing it out in terms of expectations. They've been executing very well, and they've been benefiting from this stay-at-home economy, and has also been taking market share from Casper, who has been having significant issues with their supply chain. I think the company is going to have a great holiday season, and it's probably safe to stay in for the rest of 2020, perhaps early 2021. My concern in 2021 is this. First, the vaccine is coming, and the economy is reopening. That is bad for these stay-at-home plays like Purple. Second, one of the reasons Purple has been so strong is because they control their own supply chain, which has allowed them to take market share, right? From Casper, who's having supply chain issues, but manufacturing is back open, and that means that their competitors are not going to be having the same issues they were having in 2020, which means that's going to be less market share for Purple. Third, they are going to have very, very hard comps for multiple reasons, partly because their competitors are going to be stronger, but also because it's a mattress company. It's not Amazon or Roku or The Trade Desk. The Trade Desk, that's a company that's involved in online advertising. These companies will keep generating new revenue in 2021 from their newfound shutdown customers, right? People aren't going to stop watching Roku or stop shopping on Amazon for the most part. If you started going to Amazon in the shutdown, that's just a new customer for life, most likely. In contrast, Purple will have little to no revenue in 2021 from their shutdown customers of 2020, making comps much more difficult. Purple has been a fantastic shutdown stock. It was a great choice. But right now, I would be searching for a reopening stock to replace it with in the next couple months. If you want to stay in it, I would at least take out your cost basis. Kim Wong asks, nice list. What do you think about Planet Fitness? Kim, I say you're a smart Wong. She's a smart Wong. Kim Wong. It's like a racist joke. Anyway, I like Planet Fitness, but more than I like Planet Fitness, I like Planet Fitness right now. Why? Kind of because we were just talking about. It's a recovery play. It's a recovery stock. The stock is still down since the February market crash, and it's still down year to date. Planet Fitness came into the shutdown in a strong financial position, which allowed it to weather the storm, unlike some of their large competitors like 24 Hour Fitness and Gold's Gym, which both filed for bankruptcy. What does that mean when the vaccine comes out and people start flocking back to the gym? It means market share. And what does a potentially weakened consumer in 2021 do? They downgrade their gym memberships. So the $30 to $50 per month mid-tier gyms will likely struggle to meet the consumer, while the entry-level gyms with prices of $10 to $20 per month, like Planet Fitness, they will be there to greet a weaker consumer. Planet Fitness took market share back in the 2008 financial crisis, and I expect them to do the same thing this time. That's not to say I don't have any concerns. The workout from home industry has been exploding since the shutdown. All you need to do is take a look at Peloton to figure out that one. nearly quadrupling its stock this year in 2020. Whew. Then there's Mirror, there's Tonal, and then the OG workout from home, Bowflex. Those are just a couple of the high-profile workout at-home companies. Amazon's and Dick's Sporting Goods was sold out for months and months with most of their home workout equipment. I knew this because I was trying to buy home workout equipment during the shutdown, and I had to pay quite a bit, and a lot of stuff was out of stock. A lot of these people who are spending hundreds, if not thousands of dollars to buy home workout equipment, they're not going to just be returning back to the gym the second they get vaccinated. But we do have to ask the question, how much does this demographic who are buying these thousands of dollar pieces of equipment overlap with the Planet Fitness demographic? The Planet Fitness demographic is roughly lower middle class. This demographic, they're not the people spending thousands of dollars for home workout equipment. They can't afford it. They might spend a couple $100 max, which likely is not going to buy them enough equipment to provide a high quality home workout experience. Nor is it so much money that it would deter them from going back and spending $10 to $20 a month at a gym once they feel safe. While I do have concerns over how long it will take for the vaccine to roll out in a large scale and at-home workouts, Planet Fitness financial results do help me feel more comfortable. In Q2, Planet Fitness lost $29.2 million. That's not great. But in Q3, they only lost $3.1 million. That's one heck of a rebound when many Americans are still avoiding gyms and some of their gyms were still closed. Starting in Q4, I expect Planet Fitness to be back to profitable. Now, you take that in conjunction with their $500 million in cash, and that means you probably will not have to worry about large equity offerings and dilution like you do with, say, the cruise ships or airliners. I like Planet Fitness. And now it's time for your Robinhood Snack Stock Market Weekly Review. Salesforce attempts to cement its business-to-business strategy with a possible and pricey Slack acquisition, or as I like to call it, a Slackwisition. Set your status back to active. Just before Thanksgiving break, news broke that Salesforce is in advanced talks to buy Slack. This sent the shares of Slack into the stratosphere. Are you ready for another one? Or as I like to call it, the Slackosphere.
Boo, you suck.
Okay, I'm done. Shares are up about 44%. Since the Wall Street Journal released their People Familiar with the Matter article. Slack is the office messaging app that's been playing second fiddle to Microsoft Teams, and Salesforce is the cloud software company obsessed with customer relationship management software. Salesforce and Slack have two things in common. They're both business-facing subscription cloud companies, and they are both Microsoft rivals. Lately, Microsoft has been aggressively expanding its Teams suite, offering Slack-like collaboration features. Teams is now up to 75 million users, while Slack has a much slower growth rate and is only at 12 million users despite launching years earlier. Microsoft also has a cloud CRM competitor called Dynamics, which competes with Salesforce. Over the years, Salesforce has moved towards becoming an all-in-one business software provider by doing things like offering services like data analytics. You know the word that I mean. The Slack acquisition makes sense as Salesforce could integrate Slack into their 150,000 business customers, easily boosting Slack's 12 million users. The question is Salesforce overpaying? I think Slack as a standalone company is overvalued, and I don't like the idea of paying a large premium for something I already think is overvalued. However, I am also a big believer in Mark Benioff, the founder and CEO of Salesforce. And if he believes Slack is this valuable to his company, I will take him at his word. He's earned it. As this has not been officially announced and could fall apart, and Slack has already moved an insane amount in regard to their stock, from a risk-reward standpoint, if you're in Slack, I say it is time to take your winnings and... Salesforce, on the other hand, it's a little bit of a different story. They're down roughly 8% since the news. On the day of the opening, right before the story was broke, Salesforce had a market cap of roughly $239.3 billion. The current intraday valuation as of writing this for Salesforce is $219.6 billion, representing a $19.7 billion loss of market cap. If you account for the fact that the triple Qs are up 1.2% over this same time period, you're seeing a QQQ adjusted market cap loss of $22.6 billion. The deal pricing is rumored to be under $30 billion. If we pick a number from thin air and say, okay, the deal will be valued at $29 billion, this will represent a current purchase price of $6.4 billion when you net out the $22.6 billion QQQ adjusted market cap loss. Before the story was broken, Slack had a market cap of $16.8 billion with an adjusted purchase price of $6.4 billion. That's the math we just did. That would represent a purchase price of $10.4 billion under the before story market value of Slack, or a 62% discount to Slack's before the story market value. Now, I know that was a whole lot of numbers I just threw at you, so let me clean this up a little bit. When you adjust for the market, Salesforce has already dropped nearly $23 billion for something that they maybe want to spend $29 billion on. So right now, you would only be paying about $6 billion for something that originally cost $17 billion. I do not like Slack, but that sounds like a good deal to me. I think the market has over-exaggerated the downward move on Salesforce. Additionally, if the deal falls apart, you should see a quick and strong rebound for Salesforce. I am putting $70,000 long on Salesforce for market close. Salesforce is reporting tomorrow. Obviously, that will make it more difficult to do this type of apples to apples comparison after it reports, but I'll look at the quarter and see how the stock reacts. I plan on being out of this trade within a few weeks. That's So Fitch, your favorite place to pose with shirtless dudes, I mean models, in 7th grade. Hey, they're having a moment. Abercrombie and Fitch stock soared last week on expectation-beating quarterly earnings. Online sales jumped 43%, and Abercrombie notched a profit thanks to cost cutting. Interestingly, its California sub-brand, Hollister, brought in 58% of total sales. Hollister got boosted by its sub brand, Gilly Hicks, which makes comfy loungewear and bralettes. This was a stock I was in before earnings came out, but unfortunately, the stock has given up essentially all of its gains over that depressing brick and mortar Black Friday weekend. Vax on, vax off. Vaccines have had a complicated week. AstraZeneca stock dropped 5% for the week on some not so hot news. AstraZeneca acknowledged a key mistake in its vaccine trials, which made experts question the reliability of its data. Oxford University, which jointly made the vaccine, says more data is needed to determine if it is actually effective and safe. Peace, love, the Gap? Oversized hoodie legend Gap was not exactly feeling the vibes last week. Its stock took a nosedive on worse than expected quarterly earnings. Gap's Old Navy brand saw strong growth, and its athleisure brand, Athleta, unsurprisingly performed particularly well, with sales up a record 35%. The problem was everything else. Despite a 61% jump in online sales, Gap's profit missed estimates because it boosted marketing spend last quarter. I was also in this trade, so I'm just making all sorts of good decisions this time around. Anyway, until next time, this is Jordan Knight, and this is InvestaMania, the show where we help you get rich.